Well, hello, friends. Mark Martella here for Mark's Money Matters, where I help you break your addiction to credit and bring some sanity to your finances. Well, again, if this is your first time here, welcome, Joe. It's your first time here. This is Mark's Money Matters. I have a website that you can find just by typing in markmartella.com. On that website, you'll see all the past shows that you can take a look at. Also, my 2-minute tips. Also, the past episodes of my radio show with all kinds of tips, as well as some free resources, including my ultimate budget planning tool. So just check that out at markmartella.com. Also, while you're watching the show today, if you have a question, shoot me a question in the comments section, and I'll be do my best to try to answer it. If not in the show, in an email, but that's what we're here to do today. And what I'd like to start off with is one of my favorite villains, other than Darth Vader, who I have behind me here, but Wells Fargo, and they're at it again. For those of you who may not followed Wells Fargo's wonderful history in the banking industry of late, let me refresh your memory as far as what has happened recently. So, it started with repossessions of vehicles, including vehicles of military personnel serving overseas, but they illegally, improperly repossessed over 200,000 vehicles. And you're maybe be asking yourself, how could they have done that? And what they did was they added on insurance, added it to an automatic payment, and didn't tell the people about it. Joe, please feel free to share this on your timeline. And all of a sudden, people don't have the money in the account gets overdrawn, and the cars are being repossessed improperly. Imagine walking out knowing you've made your payments and your car's not there when it's time to go to work. Or imagine being deployed overseas and coming home and finding your car not there when you've set up these automatic payments. Well, that was one of the wonderful things that they did, and they paid over, I think, $5.4 million in penalties just related to the military issues. So that's number one. What they also did, because of the high pressure they put on their people, there were 3.5 million unknown accounts that were opened so that their employees there that are under high pressure were able to keep up their quotas. And most recently, they collected $50,000 in unexpected fees or improper fees from a Tennessee pension fund. Just overcharged them $50,000. It's not like a $35 check overdraft. So those are some of the things. And then the recent one that came out today, and again, pardon me for reading some of this, but I can't make this stuff up. And you would think time after time of them, creating these problems and allegedly trying to rebuild their image, why are they still doing this? So Wells Fargo and Company has recently launched a series of advertisements, again, meant to rebuild trust with customers. But on Thursday, the Wall Street Journal reported that Wells Fargo recently discovered that employees were improperly altering the documents of business borrowers, adding information to the accounts without the consent or notifying the clients. Kind of just like what they did with opening up these accounts. It's not clear that the altering of the documents cost the clients any money. A Wells Fargo spokesman says that it didn't, but the problem is that it has a familiar whiff of going behind the customer's back, even though this is apparently on a smaller scale than Wells Fargo's earlier scandals. Well, that activity continued to occur as recently as this year, and that it has reported the infractions to the regulators. What I don't understand is why people keep banking there. How is there any trust left with them with regard to how they conduct their business? But part of it is just It's not worth the hassle of changing my account. And well, again, you can be a victim of this. So keep that in mind. The other thing is something you need to keep in mind with dealing with national banks, whether it's Wells Fargo, Bank of America, Citi. The thing you have to worry about is that, especially if you've moved from another part of the country, obviously here in Florida we have a lot of replants and retreads coming down here. I'm a carpetbagger from New Jersey, as some of my friends like to refer to me as. But, you know, if you have some financial troubles and you got sued in another state and they got a judgment against you, well, normally they would have to take that judgment and bring it to the state that you're in, say Florida, and have that recognized. Well, if they have a judgment up there and you still have a bank account that maybe you opened up here in Florida with Wells Fargo or Bank of America, they can go to a bank up there where you used to live and levy on the account over there. So if you do have some financial issues in your past that may be following you, bank local. Go to a local bank. Well, the topic I'd like to address today is a topic regarding financial literacy. And when I say that, when I use that term is you know, what do people know about handling their money? And what I see every day in my bankruptcy practice is people making the same mistakes over and over. And the mistakes are partially because they just don't have the training, they just don't have the knowledge, because it's not given out there anymore. We don't get that knowledge in high school. It's not being taught at home. And then with all the other manipulations that are out there, from not using cash in any form, by relying on plastic, by doing one-click shopping, we lose that concept of money and what it's worth and what its value is. But there is a couple of institutes out there studying financial literacy and how can we fix this problem on a global standpoint. And one of them is the Global Financial Literacy Excellence Center at the George Washington University School of Business. And each year they put out a number of papers and studies, and the head of it is a doctor known as Anna Maria Lusardi, originally from Italy, who is now here in the States. And they do a study, and there's a famous study they did right after the financial crisis, and then they followed it up this past year. And basically, they measure financial fragility. How fragile are you from a financial standpoint by whether or not you can raise $2,000 within 30 days. If you have an emergency, do you have the capability of getting that $2,000 without borrowing it, or are you stuck? The other test that a different study uses is whether or not you can come up with $400 in 24 hours. And here's some of the crazy or scary statistics, is that a lot of people can't do it. Basically, according to the 2015 study, 46% of American adults reported that they could not immediately cope with a $400 emergency expense, or would do so by selling possessions or borrowing money. Nearly 40% admitted that their immediate coping capability is less than $100. And then in 2015, another study showed that 34% of the population could probably not, or certainly not, come up with $2,000 within the next month. And you would think, well, maybe they're, you know, the population that they're studying is you know, more on the poverty level, but below the median income. Well, that is not the case. It said about 30% of individuals with incomes of $50,000 to $75,000 are financially fragile, and so are 20% of individuals in the next income band of $75,000 to $100,000. So imagine making $75,000 to $100,000 and you can't come up with $2,000 in 30 days, or you can't come up with $400 within 24 hours. It is a problem, and part of that problem is due to our addiction to credit, to living beyond our means. But the real issue becomes, how does it affect the workplace? And, when someone is suffering from overwhelming debt, and studies show that 60% of our workforce is suffering stress related to money issues. When somebody's suffering from that stress, and I see it every day, obviously, in my bankruptcy practice, they're not concentrating. The stress is causing absenteeism. The stress leads to searching for more money, going to another job, even though they may love the job they're at. They need to go someplace else. And just like if you have an employee with high blood pressure or diabetes, you're not going to know that. It's a silent killer, and so is the stress of money. And what people are really afraid of is my boss going to find out about this? And eventually, if it's not addressed and the judgment is entered and they're working, there may be a wage execution, and people become overwhelmingly embarrassed. And obviously that costs an employer money. Now they have to address this. They have to do things with payroll or their leasing company. It adds layers of cost. But the stress that people are under just kills their productivity, makes people leave. And in worst case scenarios, leads to employee theft. So it is a problem that needs to be addressed. One of the purposes here of Money Matters is to provide people with the tools and education they need to make smart decisions. But since this education is not being offered in the schools, where teachers are being forced to teach based upon trying to reach some sort of standards, hey, we're teaching for our kids to pass this test so we can get a higher rating for our schools, so we don't have to hear from the parents and the electorate and the school board. That's not in the best interest of our kids. So where can people get this education? It's my submission to you that it needs to begin in the workplace. There needs to be a change in the conversation going on that doesn't make debt a stigma, but it needs to be viewed like any other issue in the workplace, whether it's someone who has alcoholism or somebody has a handicap. We provide a reasonable accommodation. The same needs to be done for people with challenges financially, and it's not based upon income. I have many clients making high income or have to file a Chapter 13 because they make above the median income and just get swamped. And then the worst case scenarios, and why it needs to be addressed sooner as people are younger instead of later, is when people are retired and they're relying on credit cards to make ends meet, and all of a sudden a spouse dies, the credit cards are maxed out, and they have no one to turn to. They have no family. Hi, Linda. There's no place to turn. And if they've been paying tons of credit card debt for years and haven't been able to put that nest egg away, and we have so many people, we don't have the pensions that we had at one time. We don't have people with 401ks, or worse, they pulled money out of their 401ks to help their kids or to pay off credit cards or to buy an RV. Some bad investment, especially later in life, that I see people make. There needs to be a change in the conversation. It needs to begin in the workplace. And if you're an employer out there, the benefits to you are multiple. A, you take that stress away. It increases their productivity. It will keep them in your employ. Again, what is the cost of someone leaving your employment? What is the cost to replace that person with somebody new, that training, everybody else who has to fill in or take up that work when you're trying to fill them up? So you've lost that productivity there. So if you can keep that person, you're saving tens of thousands of dollars on your bottom line. And it doesn't matter the level of an employer, whether it's a new bagger at Publix or a top manager at a big insurance firm. It costs money and it hurts your bottom line at the end of the year. The other thing is it helps create employee loyalty. If it's a safe working environment where they know they can go to their supervisor if they're having help and get the direction they need through a financial literacy program, you're developing that bond. And if you have multiple employees do that, I mean, the key to changing someone's mindset, the key to creating the habits that create a financially stable environment at home is that support, that ongoing training, that ongoing reinforcement. It's not watching some 1 hour video on the computer. It's not going to 2 classes or 3 classes at some church and thinking that's going to magically change things. It's an ongoing process to having meaningful change for people. And then finally, think about this. If you have an employee who's throwing away $400, $500, $600 a month in interest because they're paying 25-26% interest on credit cards, if you're able to show them how to take control of their finances so they eliminate that debt, you've given them a net of $500-$600 a month. It hasn't cost you a dime. Their net to them is much bigger. And that $500 a month, this can be life-changing, especially if they have children, especially if they want to start a college fund, especially if they haven't started that retirement plan, that 401k, that IRA. So I'm urging you that if you are an employee, it's something to think about. The problem is there. The statistics show the amount of financial stress people are under. If you would like more information, if you like my white paper that I've recently written called Credit Lies, The Secret War Destroying American Consumers, Families, and Workplaces, I'll be happy to send you a free copy. Just shoot me an email to mark@markmartella.com and I'll send you a free copy of that. But again, something to think about. Again, this recent study by Dr. Lusardi shows that people do not have the ability to pull together very small amounts in case of an emergency. They're not being taught the proper habits any place, and it needs to begin in the workplace. Again, I'm Mark Martella from Mark's Money Matters. If you have questions, shoot me an email, mark@markmartella.com. You can see all the past episodes of my show on the website. Again, www.markmartella.com. And don't forget to check out my free resources page, including the Ultimate Budget Planning Tool, a great place to start if you're looking to take control of your finance. So again, I'm Mark Martella. Until next time, remember, you have the power to choose to live a debt-free, stress-free life. Have a great week.